Good morning, everyone. Thanks very much for joining us this morning. My name is Alastair Hinton from LGBR Capital. For those of you that don't know me, we are the distributor for Dundas Global Investors in the UK and the Heriot Global Fund. Really pleased to be joined this morning by Russell Hogan and Katie Muir from Dundas. Before I hand over to them, I'm just going to do one quick piece of housekeeping. This call is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of Dundas Global Investors and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance. With the housekeeping out of the way, a little bit of background to this session. We're always looking to bring new, interesting, engaging educational content to people above and beyond maybe the usual sort of fund presentations and portfolio updates. And I think when we put this in the calendar some months back, this is a debate that had been raging for decades, but it seemed like there was maybe a sort of another coming to a head of people's opinions on whether growth versus value was at some sort of tipping point. We were speaking to a lot of clients that were talking about the differences between their portfolio construction, whether they were looking for more value, more growth, etc. And in speaking to the team at Dundas, they really wanted to explore the way in which we look at style and the way in which we understand the value versus growth debate. And I think it was Russell suggested that we might ask, are there other ways to think about style? With that said, I am going to hand over to Russell and Katie to talk us through where that questioning or where that line of questioning took them. As ever, there is a Q&A box at the bottom center of the screen. If you have any questions as we're going through, please do put them in the Q&A box and we will come to them at the end. Otherwise, I'm going to hand over to Russell and to Katie to ask that question of, is there another way to think about style?
Thanks, Alistair, and good morning, everyone. Thanks for joining the session. I have to admit, as Alistair said, when we were first given this webinar topic, I did wonder whether we were the right people to talk about it. I imagine a lot of you on this call are much more well versed than we will be in looking at the different investment styles and when comparing different managers and deciding on your asset allocations. At Dundas, we spend each day researching industries and individual companies to identify those that are capable of long-term sustainable dividend growth. That's all we do. And how we do it is we sift rather than screen the universe. So we don't screen on certain characteristics. Instead, we look at everything so that we can learn from everything we look at. So that builds our stock by stock picture of what's going on in the global economy. And we call that our, if you've heard us talk before, we talk about that as our Dundas mosaic, our global picture of the global economy. Or stock by stock picture, I should say, of the global economy. However, in doing the research for this presentation, I personally, and Russell and I were talking about this, we've actually found it fascinating because it isn't something we would usually do. I think we had assumptions in our head about what performance of those indices might look like over certain periods. And some of those were right and some of those were not right. And so we've both learned quite a lot from doing this. So hopefully, you'll find this interesting too. So, the first slide that we've got up is we thought where better to start than with Ben Graham, who, as most of you will probably know, is the sort of widely known as the father of value investing. He was a British-born American economist who was a professor at Columbia Business School in New York. And his book, The Intelligent Investor, was first published in 1949. And it describes itself on the front cover as the definitive guide to value investing. And there's lots of great quotes in this book, but one of his most famous is probably this one. The intelligent investor is a realist who sells to optimists and buys from pessimists. So he's sort of quite firmly sort of positioning himself or sort of value investors between that. Actually, a lot of his other quotes in this book, we would actually agree with a lot of what he says. And really, there's a lot of discussion in there about the noise of stock markets and share prices being essentially a voting mechanism. And really, what he was encouraging people to do, and certainly what we try and do at Dundas, is actually focus on deep fundamental analysis, financial analysis of the underlying businesses and companies that you choose to own. And then he just wants to make sure that he is paying the right price for them, or a price that's below what he believes them to be worth. Another famous quote from Ben is, an investment in knowledge actually is the thing that pays the best interest. So hopefully in attending this CPD session, you're already following some of Ben's advice there. Moving on to the next slide, Alistair. So what is value and growth investing? You know, taking his quote, we've tried to simplify, hugely simplify the relationship between the two, categorizing growth investors as the sort of optimists, and value investors as a mix of sort of realists and pessimists. Any market is made of buyers and sellers. So in a market with just two types of investors, as we've shown here, you could say that value investors are selling, they're winners, once their kind of investment thesis has played out, to growth investors. And value investors are also picking up those stocks that haven't quite worked out for those growth investors. In terms of Dundas, we've kind of nailed our colours to the mast in terms of these categories with a paper we published earlier in the year. And I think the first webinar that we did back in May, which was titled The Oath of Optimism, and investing by the oath of optimism, and what that means for us at Dundas as dividend growth investors. So we're firmly in the growth camp. However, even within both these two categories, as you know, there are lots of different variants, which we'll maybe come on to. So in looking at this presentation, we thought we'd start with our investable universe, which is the MSCI ACWI. And MSCI have actually divided, you know, they create indices in lots of different ways by region, sector, different styles and metric, and they have divided ACWI into a growth and a value index as well. And these indexes date back to the late 90s. There's actually a 36-page methodology document about how they actually do this. I don't suggest you read it, but I'll try and summarize how they come about constructing these indices. Their first goal is to 100% divide the market cap of the MSCI ACWI. So they want to sort of cover all the stocks that are represented in ACWI and equally split that market cap. And then what they do is put the stocks into the growth or value indices depending on certain criteria. And actually, I think the first thing to say about the criteria is they're very different for both the growth and value indices. There's no crossover there in terms of criteria. So growth is very much looking at both long and short-term estimated or forward-looking earnings per share growth rates. They take into account the current internal growth, implied growth rate for an individual stock. And then they also look at long-term historic, both earnings per share growth trends and sales per share growth trends. And they sort of weight those pretty equally when they consider, when they develop a score for each stock. And then similarly, they do exactly the same, looking at what they call fundamental metrics. So on the value side, so they will look at price to book value, they will look at 12-month forward earnings to price, so your forward PE, and they look at dividend yield. So it begs the question, why are these two circles overlapping? Because what happens if a stock has the characteristics of both? What happens is the stock goes into both indices. So there are some stocks that are in the value index and are also in the growth index. And what happens is their market cap is apportioned at a ratio between the two indices. So I mentioned subcategories when I talked about the slide before. And really, the intersection of these two circles could maybe be considered growth at the right price, so sort of GARP style investing maybe, or is it fading growth at the fading price? Which makes me think of one of Alan's favorite sayings or quotes he refers to often is it catching a falling knife? Is there a reason it's been valued the way it is? And it's something we need to be wary about as growth investors and as value investors. Just moving on, so what does that look like in terms of stock numbers? So at the end of October, and these are taken from MSCI, publishes fact sheets at the end of each month for all its indices. And the MSCI ACWI itself, the global sort of all country world index, has just under 3,000 constituents, so 2,995. The ACWI growth indices at the end of October had just over 1,300, and the ACWI value index had just over 2,000. So I guess the first thing to note in that is, given how these indices are constructed, is you'll note that when you add those two together, it's more stocks that are in the ACWI itself. So indeed, it's actually 352 stocks within ACWI are in both indices, both the growth and the value indices. So that's the first interesting fact that I learned in doing this is you can be in both indices. And these indices are reviewed semi-annually by MSCI. And over the past 12 months, if you look at sort of turnover for the ACWI index, the change in names is about 4% in terms of turnover over the last 12 months. If you look at it for the growth and value indices, these change, the number of stocks that change in these indices is way higher. So you've got the growth index at 23%, the value index at 25%. So that's by sort of market cap. But if you just sort of convert that into sort of as a rough estimate, as a number of stocks that are going in and out of these indices, for ACWI, it's about 120 name change per annum. For growth, for the growth index within ACWI, it's 320 names, and for the value index, it's over 500 names. So quite a huge amount of turnover in how the individual stocks are characterized. So what stocks are in these indices? These are the top 10 constituents of both the ACWI growth and the ACWI value index. A lot of probably there's not many surprises in terms of the top 10 growth names. If you think about sort of US tech and FANGs that has been dominating the headlines and sort of performance more recently. I think what's really interesting is the concentration. Again, maybe something that's not a surprise when you know what's been driving the market. So the top 10 stocks within the growth index are 29% in terms of weighting, and the top 10 within value are actually only 11%. And I think what I assume is happening within these indices is, once value stocks have had their good run, they get promoted or they jump from one index to the other. So they're sold by value and maybe bought by growth is my assumption. Another example of, I looked at this for the sort of the world growth and the world value indices. I looked at it for US growth, US value, and I also had a look at it for emerging markets. And what's interesting in emerging markets is the third biggest growth stock within the emerging markets index is Samsung Electronics, and the biggest stock within the emerging market value index is Samsung Electronics. So it's just a sort of one example of a stock that is in both indices. And I mean the blue shading on this chart here is the stocks that are held in the Heriot Fund. So as much as we would style ourselves as growth investors by DNA, we're focused on dividend growth. So maybe a slightly different subset within the growth category, but we have names that are both in the growth index, the ACWI growth index, and in the ACWI value index today. Home Depot and Walt Disney are the two in that top 10. And just considering this, one last thing before I move on, from an ESG perspective. So the kind of circles on either side of this table are MSCI's ESG ratings for those individual holdings. So we thought we'd put them on there to see if there's any kind of pattern in terms of the individual indices. And just looking at that, it probably suggests that growth stocks that have been categorized in the growth index, maybe have better environmental, social, and governance practices than value stocks. There's more where AAA is the highest rating you can get from an MSCI ESG research perspective, and B on this page, the red circle next to Pfizer is the lowest. It appears the growth top 10 has more A's and B's, or certainly more A's than the value indice. But it's worth noting that the MSCI ESG ratings on a standalone are very industry specific. So when they rate a company, they're very much comparing it to its peers and to other companies, and to its industry. So what you do see in these two lists is that IT clearly dominates the top 10 within growth, whereas you've got a mix of financials, healthcare, communication services, and other sectors in the value top 10. Just moving to the next slide. So this is just unpacking those sector differences in the two indices as well. I'm sure we've got an idea in our head what they look like. I certainly did, but this is again taken from the fact sheets. So actually, if you tuned into our webinar we did on the US versus the rest of the world a couple of weeks ago, there's actually, my first take was there's quite a lot of similarity in the sector splits, with the US index and the ACWI growth index being much more heavily weighted towards technology and consumer sectors and communication services. You've got sort of big names like Alphabet within communication services, while EFI value indices are heavier in financials and more cyclical industries, which as well you might assume. Interestingly, healthcare as a sector is the third biggest sector in both the MSCI ACWI value and the MSCI ACWI growth index. So there's both names that sit on both of those indices. When looked at by region, actually there's not much difference. ACWI is at 58% US listed companies, and the value index for ACWI is about 57%, and the growth index 59%. So really not much difference there, and we believe that's part of the construction, is they're trying to keep that fairly similar across the two as well. Just a couple of final slides, and then I'll hand over to Russell. So this is showing some of those characteristics or metrics for the various indices. So as you might expect, bigger market cap for the growth index versus value, lower yield for value versus growth. And when expressed using our favorite metric, which is the dividend payout ratio, you hear us talking about so much, the growth index companies are paying out about 35% of profits and reinvesting that leftover, the bulk of their profits in future growth, whereas the value index companies are distributing more of their profits and reinvesting less. And from a sort of PE perspective, value clearly more expensive on a PE basis than growth, and on a price to book value. And in terms of performance, looking at maximum drawdown, the value index, much bigger drawdown, and actually that was due to the period post during the financial crisis. If you actually take emerging markets out of this and just look at world growth and world value, the biggest maximum drawdown period is actually the same. It was the first quarter of this year, and probably no surprise, the sort of world value index fell almost 40% versus a better performance by growth. So growth stocks held up better during that period. So just turning on to the final slide before I hand over to Russell. So how have these two indices performed over the last 20 years, which is the history we could get for it? So this map, the blue line is the ACWI Value Index in the top chart. The grey line is the ACWI Growth Index, and these have been indexed to 100 at the start of 2001. So returns, total return with net dividends reinvested for the value index at 4% per annum over this period, and a return of 6.4% per annum for the ACWI Growth Index. And the chart at the bottom shows the relative performance of the two indices. So what you can see there in the blue shading is the last period of sustained outperformance that value had was in the 2003 to 2007 period. So that was really in the run-up to the financial crisis. So during that time, the value index actually compounded at 25% per annum. And that was really led by materials sector, the energy sector, with China's manufacturing boom and commodity demand, and also the banks prior to the crisis. Dividends during that period for the value index also compounded at around 21%. So, very strong dividend growth, and the value index yielded just under 3%. At that same time, the growth index dividend growth was around 9% per annum, so much lower level, and growth obviously underperformed relative to value. I think what's really interesting as well is, and it certainly surprised me, was really that outperformance by growth when you're looking at the very long term has actually happened relatively recently when comparing the two indices. You'll see sort of at the bottom right, really it's from sort of mid 2019 that sort of takeoff in terms of the growth index versus value. And then looking at the same 20-year period and thinking about it in terms of the components of long-term return and how we think about the drivers of that long-term return, how has dividend growth performed over that period? So dividend growth for the ACWI Value Index has grown at 4.6% per annum. So that's compared to a total return of 4% per annum. And dividends for the Growth Index have grown at just over 5% per annum. So actually very, very little difference in the dividend growth over that long period for both indices. But clearly the Value Index had a much higher yield than the Growth Index, and has had a little bit of a valuation headwind during that time. With that, I'll hand over to Russell, who's gonna pick up on those long-term drivers of equity performance.
Okay, thanks, Katie. So Katie's unpacked for us a lot about the detail of how these value and growth benchmarks work and their long-term returns. But what I want to do now is just take a step back and just look at what actually drives those long-term equity returns that Katie's been describing to us. So if you just go to the next slide, there we go. Some of you who know us well will have seen this particular slide before. So what we're looking at here is a study that MSCI did for the Norwegian Central Bank, and this was done back in 2015. And really what we're looking at here are three components of that long-term equity return: yield, which we would understand, dividend growth, and then what they call valuation. And valuation is mostly what you think it would be, but there are some other small factors in there too. You might ask, why did they choose dividend growth for this study? Well, really, I think there's probably two reasons. The first one is that dividend growth is a much smoother series over a long period of time than earnings, which tend to be much more volatile, and we've certainly seen plenty of that in the last few quarters. But even more important, I think, is that dividends give a better indication of the underlying business performance for individual companies and the underlying performance of businesses in general when we're talking about indices. So when you look at this over 1 year, or certainly, getting back to that noise that Katie mentioned right at the beginning of the presentation, you find that noise, the variability in share prices, it really drives a lot of equity returns over even just a 1 year period. But the longer that you take the series, you go from 1 year to 10 years and certainly out to 20, what you find is that it tends toward being a combination of dividend growth and dividend yield as really being the main drivers of equity return. So if you think about that, if we thought about a very long-term series for equity returns, we could probably debate it, but let's just say about 7.5% for very long-term equity returns. And really what that would boil down to using this chart here would be about 2.5% coming from dividend yield and about 5% from dividend growth. And that 5% number is a pretty good number if we're looking at long-term series. And indeed, you know, the 20-year numbers that Katie just gave us, pretty much around about 5%. So this study covered that particular 20-year period from the mid-90s to 2015. Other studies, which are over a much longer period, some of them go back to the beginning of the century, and they show really pretty much the same thing. That if you focus on dividend growth and dividend yield, then you're getting bulk of those long-term equity returns. So just getting back to the topic, so how does this fit with value and growth? From our point of view, I mean, we spent a lot of time decomposing returns in the 10 years we've been around. We've looked at particular sectors or industry groups. We've looked at particular regions. We've captured data on dividend growth over those periods. And really what we've come to believe at Andas is that dividend growth plus dividend yield does indeed explain 80% and above of the returns most of the time. Not all of the time, but most of the time. And some of the industries, you would classify those as growth industries, like IT, and some of them you would classify as value industries, you know, and we're looking at things like energy or raw materials or utilities. And actually, it seems to work pretty well in all of those industries. And secondly, and perhaps more importantly, when we think about this, at the individual stock level, we've now owned in our 10 years something like about 125 companies. We own about 66 companies today. And what we found when you get down to that kind of granular level of individual stock holdings, that actually thinking about the returns from those individual stocks over long periods of time, 8 years is where we're at today, that actually many of those individual stock returns, you know, really boil down to just yield plus dividend growth and not much else that gets in the way. Yes, there are exceptions, and we're going to find out one of those just in a minute. So just final point in this slide before we move on. My question really for value and growth investors for us to think about asking when we meet with them is to ask, what is the dividend growth from the companies you own? Because it's clearly important whether you're a growth investor or a value investor, what kind of dividend growth has actually been delivered by the companies in that portfolio over a long period of time. Okay, Alistair, if you just like to go to the next slide, please. What we've attempted to do here, royal we, it was mostly Katie rather than me, okay? But what we attempted to do in this table is to look at our own history. So we've been managing money for clients now for 8 years, and we do have this table available if you want to see it for longer periods of time. So we tried to look at that 8 years, and we looked at the MSCI study they did back in 2015, and we tried to use pretty much the same methodology to create this table. There are two big caveats, I would say, just before we jump in and look at the details. Caveat number one is that the starting point was just as we were coming out of the GFC. So 2012 was actually the first year when dividends exceeded the pre-crash level. Okay, so that's quite an unusual starting point. And in 2020, I don't need to tell you, we're right in the middle of COVID, and dividends this year are already 15% or so down from their peak of last year. So just before we look at them, I would expect on the basis of that starting period and that end period, that the valuation or other column to be a little bit higher than we might see normally, just because the market is beginning to look through those dividend cuts that we're having right now to something of a recovery over the next couple of years. Okay, having said all that, so what do the figures show? So starting off with the ACWI index as a whole, so dividend yield 2.5% on average over the period, dividend growth about 3.5% roughly, so about 6% out of that 9.5% total return has been accounted for by those two factors. Okay. If we jump to the US, so the US dividend yield 2%, dividend growth just shy of 9%, so 11% out of the 13.5% total returns have been accounted for by those two factors. If we turn to EFI and emerging markets, I mean, the one thing that just blows me away is that over that 8-year period, dividends are actually down. Yeah, I'll just repeat that again. Dividends are down over that whole 8-year period, which probably goes some way to explaining why the total returns from both of those regions have really been poor. And what we're looking at in terms of that valuation column, I would say, is that the market thinks that those dividend cuts are going to be reversed, and therefore securities are priced accordingly right now. Okay, so we've done all of those. So let's get to the topic for today. Let's get back to value and growth. What does this table tell us for those two things? Well, let's turn to value first of all. And what it shows is that for value, dividend yield on average has been 3.5%. Dividend growth has been 1.8%. And actually, those two factors have explained virtually all of the return. So for value investors, you have pretty much had over that 8-year period a combination of dividend yield, which has been the bulk of your return, plus a little bit of dividend growth, and that's been explained really all your return. What about growth? What's going on here? So if you look at the numbers for growth, dividend yield 1.6, dividend growth 1.4, and valuation has accounted for the vast majority of that total return. And it's been a great total return of 13%. So these numbers look quite different from everything else we're looking at this page. So the first question you're going to say, hey, Russell, why are you talking about dividend growth in the ACWI growth index? It's not about dividends. Surely it's about earnings. Okay, so we had to look at earnings. So if you look at the earnings number for the growth index, the earnings number comes out at 3.4%. So even at 3.4% plus the dividend yield, we're only at 5%, and that's still well shy of total return. And even there, you might say, well, it's not about earnings. These companies, earnings are for some time in the future. These companies are reinvesting. They're spending all the profits, growing their businesses. So what about, so we looked at book value, because if you're doing that, if you're just investing for the future, then your book value growth is going to be good. And actually the book value growth for the growth index came out at a mighty 0.5% per annum. So that doesn't explain it either. On the valuation front, the yield on the growth index went from 2% at the start of the period down to 1% at the end of the period. So really there was a substantial valuation tailwind that has helped boost that index. It's also worth noting in a world in which people don't think about growth and yield, actually the growth index yielded 1.6% over that whole period. So it's not that dividends are unimportant. So do I have a convincing answer for why the growth series looks this way? No, I don't. Maybe it's to do with the way the index is constructed. As Katie told us a minute ago, the longer term 20-year numbers for growth are 6.4%, and that's made up of 1.5% yield, 5.3% dividend growth. So maybe those last 8 years have got to be seen in the context of the previous 12. But right now, I would say that those figures are very challenging for that growth index in terms of that massive valuation component. And then finally, what about us? So we're down the bottom there, Dundas Global. Well, as you probably gathered from what Katie said at the beginning, we focus a lot on dividend growth. So perhaps it's no surprise the formula for us looks pretty good. Dividend yield just under 2, dividend growth 9.5, total return just over 10. Alistair, I'd just like to go to the next slide, please. So what we did is we took all, if you prefer a chart to a table, then what we tried to do here is to replicate the MSCI study. And you can see there, just unpacking what I've just said, and really just highlights just how much of that growth index return has come from valuation and other factors, whereas the opposite is true for the value index. And there are we on the right-hand side with really all of our returns coming from dividend growth and dividend yield. If you'd just like to turn to the next slide, please, Alistair. And we've only got 3 slides to go, so we're just about there. What we like to do is we like to plot our portfolio on this chart. So let me just explain what we have here. Along the bottom, we've got the payout ratio. And so what we're looking at there is just simply how much of how much of profits are being paid out in terms of dividends, all right? And if you look at the ACWI index right in the middle there, so today about 50% of profits are being paid out in dividends, and that comes after a lot of dividend cuts that we're all aware of. So the dividend cover, if you want to call it that, is about 2 times. On the other axis, we've got yield, and for ACWI at the moment, the yield on the index is about 2.1%. If you do a little bit of investment arithmetic, so if you take the yield on the index or the yield in a stock and you multiply it by PE, you get the payout ratio. Or another way of looking at it is we've drawn these lines on here, which show you that relationship between yield and payout ratio. So you can see there's a PE line there of about 30 times, and there's a PE line there of about 20 times. So, you know, we find this really helpful to see where individual companies are undervalued and where they sit in terms of their payout ratio versus their current yield and what we think are their future growth prospects. Quite often when we show this to clients and potential clients, they start actually marking in on this chart where their current managers sit. And I think it's a really good tool for doing that. It helps to show you quite quickly where portfolios are in terms of these metrics. And we think these metrics are really important, given everything we've said about the importance of yield plus dividend growth for long-term returns. So for value investors at the moment, using the index that Katie described earlier, payout ratio is just under 60 and the yield is 3.4. And the growth index payout ratio is about 35 and the yield is just under 1%. And as you can see from there, the Heriot fund that we manage sits somewhere between ACWI and growth. Just like to go to the next slide, please, Alistair, that'd be great. So this slide here shows all of our stocks on this same basis. Along the bottom of the chart, you'll see some percentages there, and that's just showing you how much of our portfolio is in these different buckets. So in that very low yield and low payout ratio bucket, we've got about 18%, and then that would typically be about between 15 and 20 for us. In the next bucket that we call sustainable growth, between 20 and 50% payout ratio. We've got about just under 60% of our portfolio there. And then in what you might call some of these more mature businesses with payout ratios over 25%, we have about, with payout ratios over 50%, we've got about 25% of the portfolio in there. For me, really, I think that the key statistic here is, given everything we've said about value and growth, is that our 75% of the Dundas portfolio sits between 1% yield, which is where the growth index is, and 3.4% yield, which is where the value index is. So 50 out of the 66 names that we own actually sit in that middle ground between where the growth index is and where the value index is. And if you think about it this way, On that growth index, which centres around about 1% dividend yield, then about half of those stocks, half of those constituents will be less than that. And if you think about the value index being at about 3.4% dividend yield, about half of the stocks there will be more than that yield. And really what our fishing area, our space where we do that sifting that Katie described, is really in between those two extremes, between that 1% and 3% dividend yield roughly. So for us, just pulling all that together and trying to give you a summary before we take some questions. For those of us that have reasonably diversified portfolios, and that's probably most people on this call, the single best thing to look for, I would say, is a combination of sustainable yield with dividend growth. I sit on a couple of investment committees, and if I look at the best value managers that these organizations have used, they have done well to balance not just income today, but they've found ways to get dividend growth. So I think dividend growth has really got to be a part of every single portfolio. Second point is, screening plays a big part, we know, in passive management, particularly for what we might call smart beta strategies. And really, when we look at these indices that Katie described so well for value and growth, in a way, these are smart beta kind of indices, I would say. And when you do that, I mean, what these value and growth indices show what you get when you screen. And that's one of the reasons, as Katie said, that we sift. We prefer to look at all the stocks that are in our universe before we exclude any, because we think that you learn a lot from the ones that you end up excluding. So that's why we sift and we don't screen. I am actually quite surprised about the overlap between the two indices. 350 companies, that's an interesting group. And I'm also quite surprised by just how high the turnover is. I think Katie mentioned about 25% within these indices. If I look at our own portfolio, even in the last year, I think our turnover is not much more than 12% over the last year. ESG, as Katie mentioned, I think has been a big factor here. I think the divestment of some large institutional investors from some weak ESG companies and indeed industries has definitely been a bit of a headwind, I would say, for value stocks in general. But at the end of the day, for us, the playing field is really that point between the extremes of value and growth. And that's where we find, the vast majority of stocks for our portfolio. So is there another way? In answer to the question at the beginning, yes, I think there is. And I think that other way is focused very much on those long-term return drivers of sustainable income and sustainable dividend growth. And with that, I'll just hand back to you, Alistair.
Thanks very much, Russell. I think a very interesting presentation. We've got some good questions coming on email and a couple on here as well. So I'm just going to jump straight in and throw them over to you. Here's a good one to kick us off. Has something fundamentally changed that means dividend growth won't be as important going forward? I think, if we looked at that last 8 years that you were highlighting earlier, Russell, it has been a lot less important over that period, driving returns of the growth index. I mean, I think you've unpacked that in some detail, but do you think there could have been anything that's sort of fundamentally changed that will mean it's less important over the next 20, 30 years than it was over the previous 20, 30 years?
I think history is on the side of it remaining important. I think there have definitely been periods, over these longer term studies that have been done, where dividend growth plus yield has not given you that kind of nice summation to total return. But I think I'm right in saying that in those periods where that has been the case, then you've found it's come back in the next period. So yes, I mean, there are other things we could talk about here. We could talk about stock buybacks and the role of other ways of distributing cash back to investors. And we'd be delighted to come back and talk about that another day. And if you look at within these statistics we've given you, in that other category, which includes valuation, it'd be fair to say that there's some component of that, which is definitely to do with stock buybacks. And you could argue that's been more prevalent among some of the growth stocks, but not all of them. So, I mean, my answer to the question is yes. Looking at that particular index for growth, then value plus dividend growth has not explained by any stretch of the imagination the return over the last 8 years. I think that's an outlier, given all the other things that we've looked at. And these outliers tend to resolve themselves one way or another, and maybe it's going to resolve itself by those companies having a gush of dividends over the next 10, 20 years. And when I look at the capability of stocks like Alphabet, for one, to initiate a dividend and gush in terms of dividends for the next 10, 15 years, it's definitely there. And maybe the same is going to be true for businesses like Amazon that dominate that index. So, maybe we're just on the cusp of those businesses generating so much cash that they're going to turn the taps on, and we'll see dividends come through.
Russell, it's almost as though you knew my next question here. Somebody has asked, and I guess it's due to the slide that's up in front of us, which has that collection of non-payers down in the bottom left-hand corner at the moment. It says, as a dividend growth manager, how do you account for the 0% payers in the portfolio today?
Yeah, and really, I mean, it's, so the way we tend to think about the portfolio, given the slide that's up there. So if I put it this way, the 25% that we have in more mature businesses, those are what we would call our dividends today. These stocks are generating good dividend growth, otherwise it wouldn't be in our portfolio, but they're generating dividends today. The next group, which is in that 20 to 50% payout ratio range, they're giving us dividends tomorrow. So yes, there's some income coming in, but really we think the next probably 3 to 5 years, we'll see fantastic dividend growth from those companies. Beyond that, so 5 years plus, that's why we've got these non-payers. Okay, so we're taking a view, if I look at, and Alphabet's a great example. We took the view when we bought Alphabet a few years ago that I had all of the characteristics, all of the financial wherewithal to start paying a dividend, and then once it starts paying a dividend, to see that really come through. It's not happened yet. Does that change our belief that it will? No, we think that in due course they will start paying a dividend, and when it does come on, then it will come on strong. And I'll just give you one example of a company that's done that. eBay. eBay did not pay a dividend until about 18 months ago from memory, and eBay is already starting to pay a meaningful dividend, and there's a lot more to come from there, which is one of the reasons we own PayPal, and we think it will follow a similar trajectory. So they're there to provide those dividends in years 6, 7, 8, 9, 10. That's why those stocks are there, Alistair.
Great. Thanks for that. Katie, I'll put this one to you. You picked out earlier 2 of the top 10, which are Heriot Holdings, which sat in the value MSCI index. Do you know how many of the 66 companies in Heriot sit in the value index? Did you work that out?
Yeah, unfortunately not. You can only get sort of visibility without sort of writing a check to MSCI in terms of the full index. But my suspicion was, when I was looking at some, what we did do is we downloaded all the constituents of MSCI ACWI, and we tried to sort of apply the same categorization or methodology that MSCI do in terms of determining which index they go into. And so it became quite apparent which of our stocks sort of almost satisfied both criteria. And it's kind of obvious from maybe some of the names that are on this page. Looking at their sales growth trends, and Home Depot's a good example of this. Their sales growth trends, their long-term earnings per share trends, their forward-looking trends. You can see very much why it's it should be in the growth index, but equally on some of its yield and sort of particularly price to book value metric. As Home Depot has actually been buying back quite a lot of its stock, you can see why it sort of fell into the value index as well. So my suspicion was we might have quite a few, but I think it's probably best represented by the, you know, kind of the more than 50% payout ratio stocks on this page that are lower valued or higher yield.
Yeah. Sorry, Russell, did you have something to add?
I know, just going to say exactly, just going to repeat what Katie said. So we managed to go as far as we could in this study without writing another $10,000 check to MSCI. But if there's enough demand out there for more information, then maybe we could let loose our purse strings a bit more, Alistair.
We'll certainly keep track. I think Katie, that feeds nicely onto another question, which I'll put to you again, which you mentioned earlier. You know that you've sort of pinned your colours to the mast, as it were, with that first presentation back in May about the oath of optimism and about optimists being growth managers. The question says, you think of yourselves as growth, but might you be considered as a blend by fund selectors?
Yeah, I mean, I think one of the terms many people might have heard of us use is a term that was used by one of our clients. In fact, our biggest client in Australia, who's been with us for the full 8 years and keeps giving us more assets to manage, which is good news. So we must be doing a good job for them. But they describe us as their defensive growth manager. So they, you know, when looking at this chart that we have in front of us, they've maybe got their ultra high growth at any price, you know, in the bottom left corner. They've got some income managers potentially in there that are maybe in the top right of this chart, and then they have us sort of firmly sort of sitting as a sort of complement to both those. So they've got someone who's providing dividends today, they've got someone that's really about very high future growth, and then they have us that sits in the middle that they think offer some more defensive qualities. So yes, in short, it's you know, where maybe we would kind of put ourselves in more of a kind of defensive growth, maybe some in that crossover space.
Yeah, and that's why, I mean, when I added up the portfolio last night, just in that band between 1% yield on the growth index and over 3%, you know, so that's 75% of our portfolios in that middle ground in answer to the question, and, you know, 50 out of 66 names, Alistair.
Yeah, no, I think that's really, really useful. I mean, you touched on at the beginning, you're sort of spending all your time, you know, looking at the companies, and it's always interesting to see how others see the strategy, I suppose, and where it maybe fits in sort of normal portfolios. Another question which has sort of come in two parts. The first part is sort of not part of the question, but I'll read it to you. I'll put this one back to you, Russell. Is you've done very well, but the hidden element surely has been sector selection. And then that's followed up with, sorry, that isn't a question. The question is, how much of your excellent return has been sector selection?
Okay, so let's just spend 2 seconds on this. So, you know, I'll tell you what we didn't do. We didn't come to work one day and decide that we were going to have 28% in IT and 24% in healthcare. And I think you probably understand that. So what we did come to work was, you know, looking through those 2,500 names, and actually, you know, we've got, I think I've said to most of you before, we've written notes on about half of those companies, just over 1,300. And really what happened was, to use a phrase, the stocks found us. And really the stocks that found us from that bottom-up perspective were, you know, increasingly in IT. And that's been great in terms of dividend growth, and it has been great in terms of return for us. But also we found a good number of names in healthcare. And again, returns there have been good, dividend growth's been good for us there. But we're probably not considered, like a financial stock picker or an industrial stock picker, just to name a couple of sectors. But actually, we've done really well out of our financial names, and the reason that we've done well there, I think, is because we're looking for the same things. We are looking for dividends that are well covered, and we're looking for sustainable dividend growth. So I think in answer to the question, I still believe that our portfolio is a really well diversified one. Within healthcare, we've got 2 or 3 different growth drivers. Within IT, we've got about 4 or 5 different growth drivers. So it's far from just being focused on the Apples and Microsofts of this world. So I look at our portfolio and I like the fact that we're diversified in terms of the names we have, and I like the fact that we're diversified in terms of where our returns have come from, and not just by industry but by geography too, which is something we talked about last time, Alistair.
Yeah, and I think, look, we can follow up with the attribution analysis on that, but it does tend to point to exactly your point, that the vast majority of the alpha, a lot of the sources of the alpha is stock selection, rather than any sort of sector sort of bias. Obviously your stock selection has led to some overweights of sectors that are cyclically growing, but it is the stock selection that drives everything.
Yeah, that's right.
That's it in terms of questions, and very neatly takes us, I think, to the end of the hour. So thank you very much, Russell and Katie, for your time this morning, and thank you everyone for joining us either live or on the video if you've watched this on the content library on the website. If you have any questions that you'd like to put to the team, or you'd like to talk to us about anything covered in any more detail, please do just get in touch with your contact at LGBR Capital, and we'll be only too happy to set something up to have a further conversation. But otherwise, that's it from us. Thank you very much again, Russell. Thank you, Katie, and thank you everyone for listening.